Thank you everyone for attending our webinar today. So we will be talking about our tax season series. Today will be about top tips to be transfer pricing ready in Singapore. Now, why did we bring this topic for presentation today? Essentially, it's because the tax season in Singapore is now here, and everyone now should be, or most Singapore taxpayers should be now doing their income tax return and getting ready to present the tax returns by 30 of November 2023. Now, why is this important? And some people might be thinking about, so why transfer pricing ready when we have to launch the tax return? So hopefully, if anything people is going to get out of today's webinar will be to understand why is it important to be also transfer pricing ready by the time we launch the tax return. So hopefully we can answer that question. So that's the biggest question, Bingjing, for today. Why do we need to be transfer pricing ready by the time we launch our tax return? So before we enter into the detail, let me just give a brief overview for those who are new. So our firm is called Transfer Pricing Solutions, and we offer transfer pricing advisory services to multinational groups in the Asia Pacific region. We have 4 offices: Australia, Singapore, Malaysia, and UAE, from which we cater to the Asia Pacific and Middle East region. So apart from that, just for information, we are a tier 2 firm, and we also have some contributions on industries such as very well-known and recognized journals in both Singapore, Malaysia, Australia, and a few awards under our belt. For those who don't know me, my name is Adriana Calderon. I'm the technical lead and managing partner for Singapore and our Asia business, co-founder of Transfer Pricing Solutions Asia and Malaysia. My background is actually in tax and international tax. I'm a tax lawyer. But over the past 15 years, I have specialized in the area of transfer pricing, helping a lot of multinational groups dealing with their transfer pricing challenging issues and international tax issues. And today, I am fortunately enough to have our manager with me who has come across to join us, Bingjing Yam, who started his career in the Big Four in 2010 in Malaysia, assisting companies with across all levels of transfer pricing issues, and particularly also with a lot of experience with negotiating 3 unilateral advanced pricing agreements with IRB. And he is also very experienced across industries, and we are fortunately enough to have him join us and bringing his more than 10 years of experience in transfer pricing. He's another crazy person that has been sustained himself for more than 10 years in transfer pricing. So that's another thing that we all have in common, isn't it? Welcome, Bingjing.
Thank you.
So I'm sure between Bingjing and I will be able to cover a lot of the key issues that keep most multinational groups awake at night. So Bingjing, why don't we start with giving a little bit of an overview of the key tax aspects that are relevant to TP, and what are the transfer pricing requirements in Singapore that cross-reference with tax?
Sure, thanks, Adriana. So literally, there are 4 things that we're looking at today. So now, first thing, we're looking at the income tax return and related party form. So the IRAS actually audits taxpayers' compliance with the respective taxpayers' transfer pricing documentations and arm's length pricing requirements as part of their compliance program. So the IRAS has implemented this related party transactions reporting requirement for companies with effect from year of assessment 2018. So this form will provide a snapshot of the company's transfer pricing position to the IRAS, and this form is part of the Form C. Just a gentle reminder again, the deadline to complete and submit this form is by 30th November 2023. So what need to be included in that form? Next, Adriana. Yeah. So these are the details of related party transactions that do be reported in the form, which you could see that is very common, which is sales and purchases of goods, services income and expenses, interest income and expense, and year-end balances of loans and non-trade amount that need to be reported in the Form C. Next, Adriana. Just before I forget, those transactions are to be reported, be it domestic or cross-border transactions. So who needs to complete these related party transaction forms? So all taxpayers with related party transactions exceeding Singapore dollar of 15 million during the income year, and the threshold calculation is determined as follows. So you have to add up all the related party transactions as reported in your income statements, but excluding compensation paid to key management personnel and as well as dividends. Nevertheless, the threshold also includes year-end balances of loans and non-trade amounts due to and from all related parties. So as I mentioned, the threshold should include domestic and cross-border related party transactions. And we understand that actually there are a lot of regional HQs in Singapore, but bear in mind, this RPT threshold applies to single entity accounts opposed to consolidated amounts.
Binjin, one question that comes to mind here is, why would IRAS request taxpayers to fill a form in the income tax return to disclose related party transactions when under Singapore account or under our accounting standards, taxpayers disclose related party transactions in the related party note? So isn't there a double lap there, or why do you think this is happening?
I guess one of the concern is that in the audited reports, you don't segregate whether those transactions are domestic or cross-border. So in this form particularly, they request you to segregate it whether it's domestic or cross-border transactions. And also, as I mentioned earlier, this will be providing the IRAS with the relevant information to better assess companies' transfer pricing risk and to improve on the enforcement on the arm's length principle requirement. So I guess this is the main concern that the IRAS has, and why it seems to be a double work to the taxpayer, but there's a need to them.
Yeah, and I guess the other thing is that Singapore is aligning also to the general requirements in Asia, where most taxpayers, the first thing that they have to submit before the tax authority is some form of reporting in the income tax return, which is mandatory. So with this, we have covered requirement number 1, which is the related party form. Now, why don't we start talking about documentation? Because as you know, one of the requirements that we all have in our minds is, okay, transfer pricing is only about documentation. But what I really want you to explain here is, what form of documentations do we have in Singapore and why is it relevant? So maybe let's start with the point of master file.
Sure. So the master file actually gives an overview of the whole business of the group, and then we have to incorporate it, the relevant sections which is relevant to the Singapore business. As you can see that the second point of this slide, that it will be prepared as part of the local file for all taxpayers with mandatory TBD. So in theory, that this master file should be prepared by the ultimate parent company who has access to all the information within the group. Unfortunately, based on our past experience, where we experienced that master file was not made available to the local entity, or it wasn't prepared in the English, which it has to be prepared in the English because we has to rely on some of the information given in the master file to incorporate in our local file for our Singapore entities. So let's see what's the content in the master file.
Thank you, Binjin. So what is just an overview of what the content is?
So you could see that there is much more about the business description relevant to the groups, what are the functions and the value chain analysis. But bear in mind that you see that whenever there's some intercompany financial activities, let's say you have an intercompany loans, then you have to disclose it accordingly. So no way you could hide it anymore. Then as well as you see the description of service arrangement, be it a management services or engineering services or consulting services, that you have to disclose it in the master file accordingly. Yep, that's pretty much that. Last but not least, that if let's say there's any business restructuring within the group during the financial year, you would have to disclose and describe what has happened, what has been changed, what has been restructured within the group.
So I guess in Singapore, looking at these, seems to me that the taxpayer has the option to prepare a master file on a standalone basis or include it as a group level information as part of the local file. What are some of the challenges, practical challenges that you have encountered from Singapore taxpayers when it comes to preparing this type of master files?
I guess they don't have much information. The master file has been prepared by the ultimate parent, but it wasn't made available to the local entity. So it may be a bit, if let's say we are going to prepare a master file perspective from a local perspective, so it might be inconsistency in terms of information has been prepared from the master file prepared by the ultimate holding as well as the local entity. Second, sometimes the master file has been prepared in the local language of the ultimate parent company is located in. So bear in mind that we have to, the taxpayer is required to translate it into English and make it readily available in Singapore. So these have been challenges that we have seen in the past few years.
Yeah, and I think another challenge is the fact that head office doesn't necessarily understand a lot of the times why do you need to prepare this in Singapore, because if you look at most of the data available about requirements in Singapore, no one talks about the master file and no one talks about the fact that our local file is a funny one because it involves both master file and local file. So I think the education to head office to explain to them that you do have to go into the detail of the group is also a bit of a challenge, because a lot of the times head office will not be very willing to share this type of information. So how about the strict local file of what it is the particular local file in Singapore?
So the purpose of preparing a local file in Singapore is to prove that compliance with the arm's length principle by Singapore taxpayer. And hence the taxpayer in Singapore are required to prepare and maintain a contemporaneous transfer pricing documentation. So bear in mind that this arm's length principle is the international standard which to determine the transfer price, which has a substance, and it has to be conducted at arm's length. So in many instances, we have seen that companies paying a management fee to a paper company which does not have a substance. So it may be create a red flag to the IRS if they came to know that, why are you paying to someone who does not have an employee in that company? So that might be, that's the reason being why we have to prepare a local file to defend what we have been transacting in the past with our related parties.
That's a very good point. And I think the other point is that at the end of the day, the burden of proving that there is compliance with the arm's length principle is on the taxpayer's hand. So the taxpayer is the one that has to prove. What about a general overview of what the local file is and how generally taxpayers go about it?
So in the general basis, the local file is focused only on the Singapore taxpayer business. So it has to be prepared by taxpayer that mandatory with a transfer pricing documentation, and it has to be ready by the lodgement of your tax return, which is approaching soon, which is on 30th November 2023. So under this arm's length, the IRS actually requires that under this arm's length principle that requires the transfer price between related parties are equivalent to the prices that unrelated parties would have charged under the same or comparable circumstances. The IRAS actually recommended taxpayer to adopt a three-step approach, which is laid out in this slide, which the first step, to conduct a comparability analysis to identify situations or transactions undertaken by unrelated parties that are same or comparable to the related party transactions that taxpayer has been transacting. Second step, to identify the most appropriate transfer pricing method and which entity to be selected as the taxed party in performing this transfer pricing analysis. And the third one is to determine the arm's length result. Yeah, so after this, well, Adriana, so who are the persons that really needs to prepare a transfer pricing documentations?
Okay, so maybe I start with here with elaborating and trying to answer a little bit of our first question, or our main question, which is like, what does the documentation has anything to do with my tax return? So as we have been saying, the documentation is the way in which the taxpayer proves that there is compliance with the arm's length principle. What that means is that I am not overstating my deductions in my tax return, understating my income in the tax return, or overstating my losses. So the reason why the documentation needs to be ready by the time you lodge your tax return is because it helps the taxpayer to prove that the tax form computation items that are associated with related party transactions are properly valued at a market price. So if you don't comply with the arm's length principle, you will be essentially lodging a tax return that has incorrect figures. And that has some consequences for the taxpayer. Now, why is this relevant? Because the way in which Singapore has drawn the Income Tax Act is in a way that transfer pricing documentation is mandatory for certain taxpayers. This started and was changed from year end 2028, which was year of assessment 19. That is taxpayers who meet either of the following conditions: when the gross revenue is greater than 10 million, or when TP documentation is required for the previous basis period. There is some exemptions, which are essentially when the gross revenue of the taxpayer is consistently below 10 million, or for certain transactions under also called specified transactions, which is essentially exemptions based on the type of transaction or on the value of the transaction. As Benjin mentioned earlier, we have to prepare both master file and local file, whether it is within the same document or as a separate. But both need to be prepared. They need to be updated every year, which is something that is very misleading in Singapore, whereby a lot of people believe that it's only every 3 years. In September, I think 2 weeks ago, there was a session with IRAS where they were very clear about that they expect annual review and annual testing. It's just that we will see in the following slides that there could be 2 variations. And again, I think this is when Singapore has tried to align with worldwide standards, because no one in the world you can review your documentation every 3 years. In most countries, you have to do it every year. And then you have to submit it 30 days upon request, at the time that the IRS requests from it. But from a full compliance point of view, the taxpayer has to have it ready by the time you lodge your tax return, because of the reason I was saying earlier, is to support that your tax return has been computed properly. And the way IRS check for this is by asking the taxpayer to compulsory put the day of completion. So compulsory, you have to date your documentation by that it has completed before or at the latest by 30 of November 2023, this year, local files with master files for all the tax returns that are going to be lodged for the year of assessment 2023, which is the financial year end 2022. Okay. Now, it is important to say that this is for these taxpayers is mandatory. If the taxpayer is not within mandatory, then you will, strictly speaking, not be obliged to prepare documentation, but we will discuss in the later slides that you could still be subject to certain penalties, which we will talk about in the following slides. Before we get into that, it is good to know that, as we said, deadline is 30 of November 2023 for this year. So now, what are the exemptions? There is 6 types of exemptions. Exemption number 1 is when the taxpayer has consistent revenue under 10 million. Consistent means for 3 years of assessment or 3 financial year. At the 3rd year, then you are exempted. Not at the 1st, not at the 2nd, at the 3rd. So year 1, year 2, year 3, 3rd year, you are exempted. There is another exemption, which is for related party domestic transactions, because in Singapore we have domestic TP, where the related parties are subject to the same tax rate. Third exception is related party domestic loans, where the lender is not in the business of borrowing and lending. The fourth exception is for related party loans in which the indicative margin published by IRS is applied. The fifth exemption is for routine services where the taxpayer apply a 5% markup on cost for services considered, the key here is routine or low value, as opposed to core to the business, and IRS has a particular list of activities that are listed as a guidance to know whether it is routine or not routine. And when the taxpayer has entered into advanced private arrangement where the related party is covered under it, then therefore, because you have done some pre-work and negotiation, you wouldn't be subject to obligation of TP documentation. So those are the exemptions in Singapore based on a specified transaction. Then we also have the value exemption, which is basically if a transaction is below these thresholds, based on value by type of transaction, you could still be exempted from documentation, even if your revenue is above 10 million. So for purchases of goods from all related parties is 15 million, sales of goods to all related parties 15 million, loans all to all related parties is 15 million, loans all by all related parties 15 million, provision of services to all related parties 1 million, provision of services from all related party 1 million, and any other transaction 1 million.
So Adriana, I have questions to you, because if you recall what I said earlier, which I said that in the RPT disclosure, they need to disclose the year-end balances for loan. But now when I'm looking at this, they say loan owed to or owed by related parties is 15 million. So does it refer to the year-end balances of 15 million?
No, it doesn't mean to the year balance. It means to the total loans that has been committed as per the agreement during the year. Even if you don't draw down the total loan.
Okay, so I guess this 15, everyone has to bear in mind that this 50 million does not equals to what you have been disclosed in your related party form, in your form C.
Exactly. So, because if your closed balance is below 15 million, but you have within the year a loan that you have committed to be above 15 million, then you will have to prepare documentation. So that's a really good clarification. So let's see this example so people understand how it operates. So I could have a company A incorporated in Singapore that has 20 million in revenue for 31st December 22, and my related party dealings can be 1 million, purchases of goods, and 500K management fee income. So in this case, the company is, in theory, required to prepare mandatory documentation because its revenue is above 10 million. But then the question is are the transactions exempted? And the answer is yes, because the values are below the threshold, which for purchase of goods is 15 million and for management fee income is 1 million. Then we have another scenario where company B, incorporated in Singapore, has 30 million in revenue for 31st December 22, related party dealings 16 million purchases of goods and 500K management fee income. So here again is mandatory because the company has revenue above 10 million. Then the question is for which transactions, and then in this case we will have that is for the purchase of goods of 16 million, assuming that this is a cross-border transaction, or if it's local transaction, if they are not subject, the parties are not subject to the same tax rate. Then the management fee income will be exempted. Okay. Now, the question here is, are they exempted to comply with the arm's length principle? Definitely not. Arm's length principle is a different story, which we will talk about it in the following slides. Just for information, this is a flow chart that is quite useful. This is from IRS tax guide that helps any taxpayer to be able to determine whether it has to prepare documentation or not.
So what happened that if let's say I only have domestic transactions and I don't have cross-border, am I automatically exempted from preparing a TP doc, Adriana?
No, I am not automatically exempted because in Singapore, we do have TP for both cross-border and domestic transaction. The reason being that there is still could be tax leakages in domestic transactions because of our incentive framework. Hence the reason why, for example, single family offices, you have a fund manager and a fund, and if it's all onshore, then there is a specific requirement to be able to sustain in the incentive that you're gonna have to have documentation, even though it's all local. But the reason being that if they are under incentive of Section 13, one will be, the fund will be exempted or a particular concessional tax rate. I believe it's actually no tax rate at all, whereas the fund manager will have a full tax rate. So those are scenarios where you will have to have documentation because there is a differential rate. So strictly speaking, actually, the exemption of domestic applied to domestic transactions between parties under the same tax rate, and domestic loans when the lender is not in the borrowing and lending business, mainly because we do have local tax rules around this.
Understand that actually the time frame required to prepare a TP doc is quite, it could be long, it could be more than 1 month, it could be more than 6 months. So what is the practical time that a taxpayer should have prepared their transfer pricing documentation?
So in Singapore, we have the rule that contemporaneous can be when you're setting your transaction, but can also be at the latest when you lodge your tax return, which we have been discussing earlier. Now, there is some practical aspects here. If you ask me when is the optimal time, I will say that when you set your control transaction during the financial year. Why? Because if there is adjustments, you have to consider first the accounting impact of the adjustment, where you have to put the accounting adjustment through your books. To the tax impact, because remember that tax is determined based on your profit before tax as per your audit financial statements. So if there is an underprice or an overprice, that means your profit before tax calculation in your audit financial statements is wrong. And then your tax return is also wrong. So even though you can prepare it even after 9 months in Singapore, even 10 months, oh no, more, 11 months after your closing of the books, and a lot of the time taxpayers come and do it after they finish the audit. The reality of it is, if you're a taxpayer that is doing it for the first time and have concerns, it's better to do it within the financial year. In fact, we are just working with a few projects where we're doing this, right, Pinjin? We're doing it for 23 now during 2023. So we can tell them by December if there is a need for an adjustment. Now, another thing that is good to keep in mind is that it's good to prepare in advance, because doing a transfer pricing documentation exercise takes time. It's not something that you can do like tax computation, and not even, because I don't think tax computation you can do it in one day. It takes time. So it's better to prepare beforehand, because these projects work minimum 4 to 6 weeks minimum. So it's good to really plan in advance to get it done before, well in advance, and finish it all and sign it off before the lodgement of the tax return.
So I just want curious how many days that the IRS require the taxpayer to submit the TP upon request. How many days do they give to the taxpayer?
That's actually 30 days, non-extensions allowed.
30 working days or calendar days?
Calendar days.
Oh, okay.
Yeah. And then there is an aspect here, right? That even if they request, we have to keep in mind that usually audits are conducted 2 to 3 years afterwards, after you submit your tax return. So for those that are not familiar with this, let's say we do our lodgement of the tax return 30th of November 2023. Okay? You're not going to receive the audit letter for 2022 in December, not in January. It could be 3 years down the track. So the question is, how can I do it upon request? And what is the challenge? That the first thing that IRS is gonna try to make sure to accept your documentation is that you completed at the time you lodged your tax return, not now when I requested. If they find out that is now when you requested, you are under compliance. For sure. And to be honest, it will diminish the trust of IRS on you as a taxpayer, because basically you're doing it very last minute. So that's why, again, we don't recommend that people do it when you're having the request 3 years down the track, because it has a lot of challenges in terms of time constraint, making sure that IRS doesn't find out, and obviously how good it is as well. So let's talk about annual reviews and updates, which we have been discussing earlier. So in Singapore, as we said, there is a required for annual reviews. These annual reviews can be simplified updates or full updates. Why? Because Singapore, being Singapore, has done a funny, I guess with good intentions, that it is okay. If you fulfill certain conditions, you can do a simplified update, but you still have to do an annual testing. So what are those conditions? That if I did a documentation for year 1 and the following year, my control transactions are of the same type, entered with the same related parties, I prepared my documentation fully compliant with Singapore e-tax guide, and I have all the required information, I can do a simplified update, but I still have to do an annual testing. Now, if I don't fulfill these conditions, then I have to do a full update. Is there an advantage of the simplified? Yeah, to some extent, because you will have to make sure that you make a declaration that you complete these conditions and you do the annual testing. Is it easy to fulfill the conditions? I will say it's not that easy, because business these days is very dynamic. So the chances of having these transaction or related parties change is very high.
So does it mean that, let's say, for example, in year 1, year 2020, I have sales transactions with 3 related parties. But then in year 2022, I have the same type of transactions, but instead of transacting with the 3 entities, I'm now transacting with only 2. So under such circumstances, I'm still transacting with my same related parties with the same type of transactions. Do I still qualify for this simplified update?
No. Actually, same transaction means, we have asked this IRS many times, exactly the same. Not one more, not one less.
Oh, oh, that would be quite burdensome to the taxpayer. So if I were the taxpayer, I would just say, hey, why not we just transact for $10 for the sake of I could comply with this simplified update conditions, so that otherwise I will have to spend another money to do an update for it.
I tell you
Well,
why, because business don't make decisions based on TP. They make decisions based on business. And then if I have to stop selling to someone because business wise doesn't make sense, I will do it even if I have to pay to do the TP documentation, because operations generally is not necessarily overly concerned with the tax and the TP compliance aspect of it.
yeah, true. So I guess I have another question for you, Adriana. So why should I be concerning so much in preparing a TP doc? It's so time consuming. I have to gather a lot of information from my headquarter office, from my operations people in order to prepare one TP doc. So why should I be so concerning of preparing one TP doc?
Yeah, I guess that's a good point, because the reality of it is like the first okay, I will explain a couple of things before we get into penalties. Obviously, there is some penalty aspect associated with not preparing your documentation. And in Singapore, we have two type of penalties. One, which is a funny one, because not many countries have, I don't know if people realize in Singapore, not many countries have non-compliance for just a fine for not having documentation. This is not very common, I have to say, but in Singapore we have it. So that fine is $10,000 for every offense, and there could be 4 different offenses. Failure to prepare documentation in accordance with the prescribed timing or content. So this is why when I say virus find out that you're doing it when they request it only, they can still fine you, even if you provide it, because it's not in the prescribed timing that they say. If you fail to submit your documentation within the 30 days from request of IRS, if you fail to retain your documentation for a period of 5 years, so that could be another offense if they found out, and providing transfer pricing documentation that is false or misleading. So it is important to take into consideration that this fine is for every basis period. So for example, if you miss for 3 years, you can get 10,000 per every year that you fail or you commit the offense. Okay. Then we also have the surcharge on transfer pricing adjustments, which is 5% on the transfer pricing adjustment when IRS makes the adjustment. And this 5% surcharge is imposed regardless of whether there is any additional tax payable resulting from the TP adjustment. Okay, so for example, if I'm an incentivized entity, there is a TP adjustment and I wasn't going to pay any tax anyway. So you still have to pay the 5% surcharge. And that 5% surcharge has to be paid very quickly. Now, sorry?
Yeah, I just want to ask one question, because just now you did mention about the exemption of preparing TP docs, under either is under revenue less than 10 million Singapore dollar, or even some certain specific threshold for certain transactions. So if let's say my company is exempted from preparing it, am I safe to say that the IRS will not perform a transfer pricing audit on me, and hence these penalties are not going to be imposed on me?
That's a very good question, because if you are under TP documentation, meaning you are not subject to mandatory documentation, you will not be fined for the 10,000, but you can still be subject to audit and review. And you can still be prone or be subject to a TP adjustment if IRS is of the view that your prices are not at arm's length. And you can still be subject to a surcharge. The surcharge doesn't apply only to taxpayers with mandatory documentation requirement.
I see, I see. So I would think that transfer pricing documentation is still required, or to be precise, the e-tax card did mention that even though taxpayers are exempted from preparing it, they are still encouraged to prepare one to prove that their transactions are transacted at arm's length.
Yeah, especially if they are material enough in the context of the business, I have to say, because there is no exemption to prove that you are transacting at arm's length. One thing to keep in mind as well is that if you have documentation that is contemporaneous at the time that you lodge your tax return, you could have, if there is an audit, IRS will consider a remission of the surcharge. You will also have the possibility to seek for voluntary upward retrospective adjustments. And obviously, you will not have any non-compliance. And I will say that the likelihood of being successful in defending your transaction can start with having proper documentation, but also proper transfer pricing governance. But I guess if someone is having proper transfer pricing governance, the documentation is an obvious thing that is going to be ready.
Okay,
So,
I think so. So we are going to touch about the third type of documentations that applicable in Singapore, which is called country by country reporting. So literally, this should be generally prepared by the ultimate holding company entity of the group. So as you could see from the table one, that it actually goes by the tax jurisdiction. For example, in Singapore, you have under the same consolidated group, you have three entities. So you'll be consolidating the three entities figures into these tables, which it shows that you have to disclose that how much revenue has been generated from related and third-party companies, and what is the total profit, and what are the cash tax has been paid to the government. So, and then of course, nevertheless, you have to disclose how many employees in that particular tax jurisdictions that has generated that much of revenue in that year. While in the second table will be on the qualitative kind of informations, but this time it will be specifically into respective entities. So let's say in Singapore, as I mentioned, there are three entities. So you put in Singapore. So there are three entities, company A, B, and C. And what is the main business activities? Are you a manufacturer? Are you a distributor? Are you a service provider? And are you dormant during the financial year? So these are the things that has to be disclosed in this country by country report. So Adriana, looking at there are two types of documentation required, which is master file and local file. And now we have this country by country reporting. So who actually has to prepare it? Because I guess it will be very burdensome for our companies in Singapore to operate a business in Singapore if, let's say, we need to be compliant with all these things.
well, the good news is that Singapore has made country by country reporting quite simple, because it only applies to ultimate parent companies with more than 1.1 billion of global revenue SGD. So in other words, it doesn't apply for intermediary companies, only pure ultimate parent companies located in Singapore. You need to file the CBC report within 12 months after the end of the reporting financial year. So 31st December 22 needs to be lodged by 31st December 23. Now, there is no notification requirement in Singapore to notify IRS where does the group lodging where is the group lodging the country by country reporting, which is different to places like Malaysia and Australia, where you have to report where is your country by country report being lodged. But what you do have to do within 3 months of your financial year end is to notify IRS on whether you are obliged or not. So you need to go and tell IRS, hello, Mr. IRS, I am obliged, which is a weird, I think they do have a lot of faith in on the honesty of the taxpayer, that they're going to come forward and say, yes, I am obliged. But you have to, because if you don't, they can fine you. So it's like, we trust you that you're going to come, but if you don't come, we'll fine you. So it is worth considering that you have to do that notification 3 months after your financial year end.
Okay, I guess we have listening a lot on the compliance side. I think now before the end, we have actually a case study to apply what we have learned listening in the past 30 minutes. So maybe Adriana want to explain a little bit, brief a little bit this example.
Yes, so we have an example here of a company B, a Singapore taxpayer with some subsidiaries in India, China, and Malaysia, with a total revenue of 50 million USD, and some transactions, including intercompany loans, cross-border of 16 million each, management fee received from India at 1.5 million SGD, and a trademark payment that has been received from Malaysia entity, company E, are about 3 million. So yeah, you go.
Yeah. So what does what does the company B has to comply with the arm's length principle?
Yeah, so they will have to comply with the arm's length principle on all the transactions, regardless of any. I mean, I wouldn't even look at what the value and the revenue, because it's a given that you have to comply with the arm's length principle. In other words, you are not allowed to overstate or understate prices in your income tax return.
I see. So what type of documentation required? Because we have mentioning that there are 3 types. So in these situations, how many types of documentation is required?
Okay, so the first thing that I want to, before you go to the documentation, so we understand the structure of the session today, is that the first thing this taxpayer needs to do is to report all of these transactions in the related party form in the income tax return, because clearly all the transactions exceed 15 million SGD. So they all have to be reported in the related party form and in your income tax return. Then your question of what documentation should they be concerned with?
Yeah.
So country by country reporting wouldn't apply, because if I assume that this revenue is consolidated revenue, it is not above 1.1 billion. So this group wouldn't be concerned with country by country reporting. Then the question is, do they have to prepare master file? Yes, they have to, because in Singapore, if you exceed 10 million SGD, you have to prepare both master file and local file. So in this scenario, this company will have to prepare both the master file and the local file for all transactions, because all transactions exceed the threshold. Now, a different question is whether I prepare the master file as part of the local file or if I prepare it separately. But that's more an implementation issue more than anything else.
I see. So if that's the case, I guess how often, the next question is that how often do the companies have to perform the review and updates?
For this company will be every year. The question is, what type of update do they have to you after year 1? So if year 1 is 2022, the question is 23 and 24 simplify or non-simplify? So it's simplify if it meets the conditions. It's non-simplify if it doesn't meet the conditions.
I see. I guess the next practical concern is that looking at the related party transactions value, that you see the management fee is actually at 1.5 million, which is relatively low compared to the other transactions, and actually as a just slightly above, I would say, slightly above the exemption threshold for management service fee. What if this company B is just preparing a TP doc but only covering the intercompany loans and royalty trademark, but not the management fee?
You can be fine, actually, because you are not, strictly speaking, you are not doing the mandatory documentation for all the transactions that you are meant to have it.
So I guess this is the reason why the IRAS asked for a taxpayer to declare all their related party transactions in their tax return form, so that they could easily assess which company that at the higher risk that they could go after in a transfer pricing audit.
Exactly. That's why it's so important that that understand that this is all being reported already to IRS. and that this is going, IRS has full visibility. And I guess in Singapore particularly, there is full visibility over everything. There is no such a thing as secret information, to be honest.
Okay. Okay. I think Adriana, just a very last, what are the key takeaways that you would like to remind our audience today?
Yeah, I think that contemporaneous documentation means that it needs to be ready, dated, and done by the due date, by the lodgement of the tax return, which for this year is 31st November 23. Keep in mind that audit can happen up until 5 years after you lodge your tax return, because the IRS has the ability to conduct the audit for past years, up to 5 years. So a lot of people think like, oh, it's finished, I lodged the tax return, no one called me in January, so why do I care? This is why you should care. I think another point, which is that obviously the commercial rationale, now we are with global minimum tax and all of that, we are in a world where tax planning is possible, but artificial creation of transactions is a bit tough. I will say very tough. So that's something to keep in mind, that the surcharges can be imposed regardless of whether you are within mandatory documentation or whether your adjustment is subject to tax. And that, you know, from TP point of view, strictly speaking, we have also the master file and the local file, which is the same requirements, 10 million, the CBCR, and we also have the income tax return. So that's all things to keep in mind as well. So with that, we open the floor for questions. There is a few questions, and anyone else who wants to put any questions, happy for you to do so. So let me just look at this first. Answer live. If in year of assessment 22, the deadline to prepare TP documentation was 30th of November 2022, and a company filed the tax return late, which is 31st March 23, and the TPD was completed after 30th of November 22, but before 31st of March, does it contravene with the deadline for preparation of TPD set by IRS? My take here is no, because the deadline is by the time you lodge the tax return. In fact, I have some companies who request extension to have hand in hand the Form C and the TP documentation. So no, it will be contemporaneous. I have a situation whereby the taxpayer is a family business. The year end is 31st December and the turnover is SGD 4 million annually, and they do not have related party transactions. However, on December 22, the shareholder specifically gave a loan of 100,000 to the company. An agreement has been drawn to have the loan repaid in 31st December 23, and the interest is 100-fold.
So I guess the principal is 100,000 and the interest is 100,000.
Okay, to be paid 100%. Okay. What are your comments on these terms of arm's length? Are there any TP documentation that should be carried out despite of turnover being below 10 million? Funny. Obviously this is quite of a long question, but I guess let me just put it this way. I have never seen in my professional experience an interest rate of 100%. Have you ever seen it, Binje?
No, unless I've seen it if, let's say, this is an equity in nature, yeah, you repay it in terms of dividends, then it makes more sense to me. But like looking at like 1 year, 100,000, I think.
Yeah, but you know what's gonna happen with the dividend, right? It's not deductible.
Yeah.
So I definitely think that 100% of interest rate is something that is unthinkable. I will say that this is one of those cases where the transaction will be commercially irrational, and IRS can challenge the transaction as being commercially irrational because no one in the borrower situation will be willing to accept 100% interest rate. So this is basically the unthinkable. So as it is unthinkable, even though it's below 10 million, you still have a risk of a TP adjustment for sure. So the fact that you're below 10 million doesn't prevent IRS to come and do an adjustment and do a surcharge as well. I didn't quite get the part on the threshold for loans transaction. Is it referring to the loans given for the year of a seller or the loans balanced at financial year end? That's a good point. You want to take that?
Okay, as I just want just clarify one more time that okay, in the disclosure, in the Form C disclosure, what you need to disclose is only the year-end balances. However, when the exemption of when we look at whether loan transaction is exempted, we are looking at the principal amount which is committed, regardless how much has been drawn down. But so long you have committed like 16 million Sing dollar, then you will have to do a documentation to analyze that the interest rate is at arm's length. So I guess Adriana, you have something to complement?
No, that's super clear. Okay, so I think we answered all the questions. As we always said, please follow us and subscribe to our YouTube channel. We don't charge, but we do appreciate followers, and that would be very nice. So don't miss out our upcoming webinars. Next week, we'll be talking about intragroup loans in Malaysia and then year-end tips for Malaysia. And I think we will be ending our webinars in October and give ourselves a break. I don't know how many hours of Zoom webinars do we have under our belt, but I will say that we could very well have already more than 30 hours, if not more, by the time you add up all the classes and all of that. But anyway, because of that, we will at some stage take a break and then reconvene in 2024 with better topics. If you have any topics that you want us to cover, feel free to reach out to us. My details are here. Bingjin are also here, or to any our channels, whether it is LinkedIn, Facebook, Insta. So feel free to reach out and suggest any topics, because we will be more than happy to cover them, because we are starting to do our planning for 24. So take advantage of that and send us your suggestions. Bingjin, thank you very much. It has been a pleasure presenting with you for the first time. I hope that we keep doing it for the years to come.
Thank you. Thanks, Adriana. Thanks, Era.